This is Al Brooks, and this is my price action trading course. The current module is about setups and signal bars. There's a big emphasis on the internet and in books on setups, and I think it's easy to come away concluding that a setup is a signal bar or a 2 or 3 bar candlestick pattern, and that if you simply get really good at spotting candlestick patterns, you'll make money. The reality is, I think most of the major hedge funds, most of the institutions, the high frequency trading firms make a lot of money, and they don't pay any attention to candlestick patterns. They're much more interested in context, where we are in the market cycle. Is the market in a strong bull trend? If it's in the breakout phase of a bull trend, they're buying for any reason. They don't care what the candles look like. And if it's in a strong bull trend, if there's a strong bear reversal bar, there's no way that they're going to sell. They don't care what the candles look like. If the market breaks out and then comes back to support, they're going to look to buy. If it is a bear breakout and it comes back up to the breakout point, they're going to look to sell. And again, they don't care what the candle bar looks like. I think everyone in their heart knows that Goldman Sachs, high-frequency trading firms, and all the best hedge funds out there are not really paying any attention to candlestick patterns. Yet, when you look at websites on educational videos, they're all about candlestick patterns. And so you know that something's not right, that you're being taught something that just can't be true. It's not what the institutions are doing. And that is absolutely, your instinct is absolutely correct. Institutions are much more interested in context, where we are in the market cycle, and in reading the strength of trends, looking at selling pressure, looking at buying pressure. The candlestick pattern, 1, 2, or 3 bar pattern, it can be helpful, but you don't need it at all to trade. However, it can be helpful, and because of that, I do talk about specific patterns. If you want to know what the bars to the right of the chart look like, look to the left. The market tends to continue to do what it's been doing. If to the left the market is in a strong trend, chances are it'll continue in a strong trend, and you should only look to trade in the direction of the trend. If it's in a trading range, you should only look to trade in the direction of the trading range. For example, if the market is in a very strong bull trend, it does not matter that you see a great-looking, strong bear reversal bar. You should not short. If anything, you should only buy. And any reversal pattern that you see, you should look at it and say, here's an opportunity to make money. But the opportunity is not shorting in a bull trend. What you do is you don't take the short, you wait for a bar or 2 or 3, figure out where the bears would put their stops to get out with a loss, and then enter long exactly where they're getting out. So you should look at every reversal pattern in a strong bull trend as a bull flag, not as a reversal. Reversals do occur, but there's much more to a reversal pattern than simply a candlestick pattern, and I talk about that in the section on reversals. Here's an example of a strong bear trend. So the context is a strong bear trend. That trumps anything else that you might see. So you should not look to buy no matter how strong a candlestick pattern looks like. So here's a good looking candlestick pattern, a 2 bar reversal, but look what happened. It resulted in a low 2 short. The market tried to go down here, paused, tried to go down a second time. The bulls who bought here, they might have allowed the market to go against them once, but they're not going to allow the market to go against them twice. They're going to exit here. So instead of buying this, you should simply wait. And if you're lucky enough to see this, then you go short. And look at this, okay? Here are 2 decent bull bars. And however, it's far better to short below the low of the bull bar than it is to be thinking about buying a pullback. Here are 2 small doji bars, yet look what happened. We got a breakout. So it's far better to short below their low. It's far better to short this close. I talk about in a later module how to trade strong trends. But the bottom line is, if a trend is strong, and in this example, if it's a strong bear trend, you sell for any reason. You sell at the market, you sell above bars, you sell below bars, you sell the closes. It doesn't matter. You can just sell for any reason until you get short. And you should not buy for any reason, no matter how strong a candlestick pattern is. So the context is far more important than the actual signal. And here's an example of an opposite situation, a very strong bull trend. And we have a great looking bear reversal bar. And you can say, wow, it's a bear reversal bar. It looks perfect at the top of a trend, bull trend. That's when you should be looking to short. It is, except that the context is bad. This is a very tight bull channel and a very strong bull trend, and it's a spike on a higher time frame chart. You should not be looking to short, no matter how good the reversal bar is. Instead, what you should do is wait until it turns into a bull flag. The market tried to go above this bar, and the bears probably held short because that's not a very strong bull bar. But at this point, if the market tries to go up again, especially above a bull bar, all those bears are going to cover. They may get out break even, they may get out with a small loss, but they're going to cover. So to me, when I see this, it alerts me to the possibility that a bull flag will set up. I do not take that short. I wait for this, the second attempt for the bull to go up. Here's the first attempt, here's the second attempt, and I get long because I know these bears are going to buy back their shorts, probably take a small loss, and they're not going to be looking to sell again for many, many bars. So this is a great buy setup. And look at this. Here's a bear inside bar. But it's occurring in the context of a strong bull trend. And a strong bull trend you can buy for any reason. You can buy below a bar. You can buy below this bear bar for that matter. If you use the appropriate stop. You can buy above a bear bar. Here's a bear bar and it's a good buy signal. You can buy the close of any bar. You can buy at the market. You just have to get in, and you can use any reason. And again, I have a module later on that talks about how to enter in a strong bull trend. The bar when you enter is the entry bar, and the bar that led you to take the entry is the signal bar. It might be the bar before, it might be 2 or 3 bars before. Here are some examples. Here's a signal bar, top of a channel, a strong bear reversal bar, and the next bar, the bar in which you actually enter, is the entry bar. Once you see this signal bar, if you're thinking about going short, you place a stop to go short at 1 tick below the low of the bar. You get filled on this bar, and that's your entry bar. Here, the market is channeling up in a weak bull trend, a bull channel, and there's a good-looking signal bar closing on its high tick. When you see that, you might want to buy this as a pullback from this breakout. You place a buy stop at 1 tick above its high, and you'd be filled on this bar. So this is your entry bar. To qualify as a bull signal bar, the bar should have one of 2 things. It should have at least a close above its midpoint or a close above its open, a bull body. So in other words, it can have a bear body as long as it closes above the middle of the bar. In other words, as long as there's a tail at the bottom that's at least half the size of the bar, that would satisfy the requirements of a reversal bar, a bull reversal bar. The very best ones, they open near the low of the bar, and they open near or below the close of the prior bar, and they close well above the prior bar's close. The lower tail is about 1/3 to 1/2 of the height of the entire bar, and the bar closes on or just about on its high so that there's no tail on the top of the bar. The best bull signal bars do not overlap prior bars very much, and the bar after the signal bar is not a doji inside bar. Instead, you'd like to see a strong bull trend bar for your entry bar. And you also prefer the close of the signal bar to reverse the closes and extremes of more than one bar. So in other words, you want the close of the signal bar to be above the close of the bar before it, and preferably 2 or 3 bars before it. So you want a very strong close on the signal bar. The minimum requirement for a bar to be a bear reversal bar is either a close below the midpoint of the bar or a close below the open. If it has a close below the open, it has a bear body. If it has a close below the midpoint of the bar, it can have a bull body as long as the tail on the top of the bar is equal to at least half of the total range of the bar. That would qualify as a bear reversal bar. The best bear signal bars, they open near or above the close of the prior bar, and they close well below the prior bar's close. There's an upper tail that is about a third to a half of the height of the bar, and the bar closes on or near its low. You don't want much of a tail on the bottom of the bar. You also don't want much overlap with the prior bars. The bar after the signal bar, you'd prefer it not to be a small doji inside bar. Instead, you want a strong bear trend bar for the entry bar. You also want the close to reverse the closes and the extremes of more than one bar. So in other words, you want the close of the bear bar to be below the close of more than one bar, ideally, or even below the lows of more than one bar. Sometimes you'll see a bear reversal bar that's very large, and it reaches down below the closes of the past 10 bars and the lows of the past 10 bars. And that's a sign of tremendous selling pressure. Another common setup is a 2-bar reversal. So instead of a single bar being the signal bar can be a 2-bar pattern. For example, if you're talking about a buy setup, you may see a bear bar and the next bar be a bull bar with a body about the same size and a close at the top. If we're talking about a 5-minute chart, if you look at that same chart on a 10-minute chart, you might see a perfect bull reversal bar. When the reversal takes place of a 2 bars, it's a 2-bar reversal, and the 2 bars do not have to be consecutive. You can have a big bear trend bar, and then 5 or 6 bars later have an equally big bull trend bar, and that is a 2-bar reversal, even though they're separated by many bars. And if you go to a high enough time frame chart, you'll see a perfect reversal bar. So you may have a 5-minute bar, bear bar, and then 30 minutes later you might have a very large 5-minute bull trend bar, and if you look at the 30-minute chart, you may see a perfect reversal bar. Here's an example. Here's a small 2-bar reversal. There's a bear bar and then a bull bar, and traders will buy above the high of that bull bar, treating it like a single reversal bar. And if you look on a different time frame chart, for example a 10-minute chart, maybe a 7-minute chart or an 8-minute chart, you'll see a perfect reversal bar. And then also we have a bear spike going down for 3 bars, a bull spike going up for 4 bars. This is basically a 2-bar reversal pattern. And if you look on a high enough time frame chart, this will appear as a single perfect bull reversal bar. Here's an example of a 2-bar reversal sell signal. There's a bull trend bar breaking out above a prior high, followed by an equally strong bear signal bar closing on its low. So these 2 bars create a sell signal pattern setup, and you treat it like a signal bar, and you would short 1 tick below the low of that bear bar. So you treat a 2-bar reversal exactly as you would a perfect reversal bar, a perfect 1-bar reversal bar. Signal bars need context. A strong signal bar is not enough reason to take a trade. The context has to be right. It has to make sense that you'd be expecting a breakout at this particular moment. For example, in a trading range, you want to buy low, sell high, and scalp. You don't want to buy near the top of the range. You don't want to sell near the bottom of the range. So for example, if you see a perfect bull reversal bar, but it's at the top of the range, it's a great looking bar, but the context is bad, so the setup is bad. Remember, most breakout attempts fail, so no matter how strong and convincing the bull signal bar is, and no matter how strong and convincing the bull rally is that took you to the top of the range, 80% of the time the market's going to reverse, and that perfect bull signal bar at the top of the range will result in a losing trade. In a strong trend, you don't want to be looking for reversals, since most will fail. 80% of reversal attempts in a trend will fail, and you only want to trade with the trend. If the trend is a channel with very broad swings up and down, a lot of two-sided trading, you can take trades in both directions. But if it's a strong trend, a spike, a breakout, you only want to be trading in the direction of the trend. If you want to be selling in a weak bull, in other words, if you want to be selling in a channel, you need prior selling pressure. I talked about selling pressure in another module. And you also want to see a strong sell signal bar. So whenever you're trying to sell in a bull trend, even if it's a weak bull trend, you want to see both selling pressure and a strong sell signal bar. If you want to buy in a weak bear trend, for example, if you have a broad bear channel, you need prior evidence of buying pressure, and you also need a strong buy signal bar. So whenever you're buying in a bear, you need both prior buying pressure and a very good signal bar. Otherwise, don't buy in a bear trend. Here's a perfect example of very good looking bull signal bars, but the context is bad. Here's an example of very good looking bull reversal bars right here and again here, but the context is bad. The market's in a trading range and you're right at the top of the trading range. So when the market's in a trading range, you don't want to be buying at the top, even if you have a great looking bull reversal bar. Here are a couple more very good bull reversal bars. And again, the context is very bad. You're in a very tight channel, a very strong bear channel. So it's a strong bear trend, and you should not be looking to buy above bull bars, even though they're perfect. There's no prior significant buying pressure. And you only want to buy in a bear trend if you have, one, a good signal bar, you have it, and you have it here. But you also want significant prior buying pressure, and there was no significant buying pressure in this sell-off. Sometimes the context is just not all that clear. For example, here maybe this is a major trend reversal, but maybe it's a trading range. If it's a trading range and the market's going down for 7 or 8 bars, you might want to wait for a second signal before you buy. So you have a great looking signal bar, but you're not sure about the context. So when in doubt, it's usually better to wait. Here's a situation where the signal bar is okay. It does not have a big bear body, but the context is pretty good. We have a channel with pretty good selling pressure along the way. There was a big pullback here, a two-legged pullback here, a strong bear spike earlier in the day. We reversed up after going below the low of the day, so we may be reversing down above the high of the day. This might be a trading range day, so that might be worth taking a short. Whenever the setup is weak, you need a very strong signal bar. For example, when you're buying in a bear, you need a very strong signal bar, but you also need good context when you're buying in a bear trend. You need prior buying pressure. Strong setups do not require strong signal bars. For example, you can have a strong trend and the signal bars in the direction of the trend are often bad. So you could have a very good buy setup, but a very bad signal bar. And that's okay. If the trend is strong enough, you do not need a strong signal bar. But you certainly do not trade against a strong trend, even if you do have a strong signal bar. For example, here's a bear trend and a very good looking buy signal bar, so it's a strong signal bar. And you have pretty good context. You have a low 2 short, 2 pushes up here and here. Second attempt down, here's the first attempt down. It went below the low of the prior bar, and then we went below the low of the prior bar again here. So we got some buying pressure going on. We also have tails on the bottoms of the bars. We have a possible sell climax here. So the context, I think, is supportive of a possible reversal back up into this potentially final flag of the sell-off. and then on top of that we have a very good signal bar. So this is a circumstance where there's a strong signal bar and a bear trend, and the context is pretty good. We might have a final flag setup which could lead to a failed breakout and a reversal up. Strong trends often have terrible looking signal bars, and that's okay. The stronger the trend, the less important the signal bar. Though, if you're going against a strong trend, you need an incredibly strong signal bar. But if you're trading in the direction of the trend, a lot of times the signal bars will be bad. Here's a doji, here's a bear bar, here's a small bull bar, here's a doji, here's a bear bar, a small bull bar. You got a bear bar here. You could even buy above that, the first close below the moving average in a very strong trend. Another bear bar and strong leg up. So when you have a very strong trend and you're looking to buy, don't worry about having perfect signal bars. If you wait for perfect signal bars, you won't take any trades, because if you look at this trend, there were really no great looking signal bars. Maybe the outside up bar here. So when the trend is very strong and you're trading in the direction of the trend, don't worry about the appearance of the signal bar so much. When you're buying in a bear trend, here we have a sell-off. It's a bear channel. A bear channel is a bear trend. We're following a pretty good bear bar. You want to see a pretty good reversal bar. Incidentally, this is an expanding triangle, five-legged pattern, down, up, down. So 3 pushes down, and that's a pretty reliable reversal pattern, especially when you have a pretty strong signal bar. I consider all expanding triangles to be as strong as major trend reversals. We had a bear channel down to here, a small break above the trend line which is not drawn in, and then we have the reversal. If you have a weak setup, remember the setup is both the signal bar and the context. It's better to wait. However, sometimes you can trade depending on the circumstances and depending on your trade management. If you have a weak setup, what should you wait for if you're choosing to wait? You can wait for a very strong breakout. You can wait until the market is clearly always in your direction. Or you can not take the first entry and wait to see if a couple bars later the market creates a second signal. So in other words, you go for the second entry and not the first. Here's weak context. We have a very tight bear channel, 8 bars down, 8 bars without a pullback, 8 bars with highs below the high of the prior bar. So there's no prior buying pressure. And the signal bar is a bear bar. Close above the midpoint, yes, so it's a reversal bar, but not a bull body. So that is not a strong signal bar. So we have bad context and a bad signal. So it's better not to take that first attempt up. Okay, so you miss the first entry. However, what's going on here? We have a strong bull bar for those who did take it, closing on its high, and then a second strong bull bar closing on its high, and an even bigger body. And beyond, so it's a breakout bar, and then there's follow through on the bar afterwards, another bull body. So at some point during this rally, traders have decided that, yeah, this is a bull trend. Even though we did not have a good buy signal, we have a very strong breakout, and the market now is always in long. So traders will be buying as the spike is going up. They'll be buying the close of this bar, they'll be buying the close of this bar. So you waited for a strong trend, and yes, even if you bought here or the close of over here, you missed the beginning part of the trend. The probability is so high at this point that the market will go higher, that it's perfectly good to buy, even up at this point. Your stop would be below the bottom of the spike. Okay, so you waited for a strong bull breakout and follow through. In other words, another bar up after that. So when you have that, the always in situation has reversed from a bear trend to long. So now you have a strong bull trend. a bull breakout. A bull breakout is a strong bull trend, and you can buy for any reason, including buying at the market. I have a module that talks about how to trade bull breakouts. In other words, how to trade strong bull trends. So somewhere in here, more and more traders decided that the market was always in long. And when it's always in long, you buy for any reason. You buy at the market. You buy the close of a strong bar. You buy below the low of a prior bar. You buy pullbacks. So bear reversal bar, but the context is bad for the bears. We have a very strong bull breakout. So traders will place limit orders to buy at the low of that bar, and they'll get filled one tick below its low, or excuse me, they'll get filled at its low on this bar. And they'll place orders to buy above bull bars. Here's a pullback, a bull flag, an II pattern, an IOI, inside, outside, inside, and an II, closing on its high tick, so they'll buy this. Another strong close, they'll buy that. Possible 3 pushes up, 1, 2, 3. Possible final flag after a buy climax, and then they see a bear inside bar. They might take profits on the close of that bar, or maybe one tick below its low. So if you don't get the strong breakout, you can get a weaker breakout, and you decide that the market has reversed to an always in trend in the new direction. So for example here, the context is good, maybe a trading range day and a new high. Signal bar is not all that good. So you don't have to take the short below the low of this bar. You can wait to see if the market becomes always in short. Maybe we'll get a very strong bear breakout bar. That could flip it to short. Maybe we'll get a series of bear bars. That could flip it to short. So if you wait for more information, you can get a much higher probability trade. Alright, at this point we have 3 consecutive bear bars, each one bigger than the last, and we're reversing down from a new high after reversing up from a new low. So this might be a trading range day. Now we have 3 consecutive bear bars. Traders at this point are starting to think that the market is going lower. Even if it goes above the high of this bar, they think it's going lower. So at this point the market is always in short because you think that it's going lower. So you could start looking to sell. You could sell the close of this bar. You could sell if the market goes above its high. So here, traders, they could sell closes. They could sell the close of this bar. They could sell one tick below its low, one tick below its low. They could sell above the high of this bar. Here we have 6 consecutive bear bars. Almost certainly a reversal will not lead to anything other than a bear flag. So traders will start selling at the high of the prior bar, and they'll scale in higher. Here we have 2 pushes up, a couple bull bars, a bear bar, and then another bull bar. So that's a low 2 short, a 2-legged bear flag. Traders will short below the low of this bear bar. We have a small double bottom here with big tails. Traders would probably start taking profits above the high of this bar. So you can wait for a strong breakout, you can wait for the market to become always in long, or you can wait for a second entry when you have a weak setup. I showed this slide earlier. It's a situation where it's unclear whether it's time to buy. If it's a trading range, we have 7 bars down without a pullback, and therefore it's probably enough selling pressure to make this not a reliable buy. So it's probably better to wait to see if we get a second chance to buy. First entry would have failed. Traders who bought above its high and had a stop below its low would have been stopped out with a loss. But here we have a second decent bull signal bar. So this is a second setup, a second signal. This is a more reliable buy setup. Traders would place a buy stop at 1 tick above the high of the signal bar. So the first signal was above here. Traders get stopped out when the market fell below its low. and the market immediately formed a second equally good buy signal bar. So a second entry in a potential trading range is a reasonable buy for a test up near the top of the range for a scalp. If you decide to trade instead of waiting, the past series of slides had to do with waiting for the market to either give you a second signal to become always in long or have a strong breakout and then enter. Instead, you can just trade right away when the situation is not clear, when you have a weak setup, either a weak context or a weak signal bar. You can trade using your usual approach. You can also trade a much smaller position size, maybe a half size or a quarter size. If you choose to trade small, you have a couple ways to handle it. One is to use a very wide stop. The second is to use your usual stop, and if you get stopped out and then the market gives another signal, you double up your position size on the second signal. So you take a full size position on the second signal. So if you use your usual approach and a normal size position and a stop, and you get stopped out and then you get a second signal, enter again. If you get stopped out a second time, do not take a third signal, because you're probably fighting a trend that is much stronger than you think. So if you're using your usual approach and you have a strong signal bar but an unclear context, you could buy above the signal bar, put a stop below, and if you're stopped out, wait for a second signal and then buy again. That is a very common way to handle this situation. So here's an example. You buy here, you get stopped out when the market falls below the signal bar, and then you buy again above the new signal bar. The other alternative to using your usual approach is to trade very small, like half size, maybe even a quarter size. And if you get stopped out and you get a second signal, then trade a full size position on the second signal. Or you could trade small and just use a very wide stop, so that the total dollars at risk are the same as they would have been had you used your usual approach and traded your usual size and using a smaller stop. So for example, you get your weak setup and you're trading small. Let's say you trade half size on your first entry using your normal stop. If you get stopped out, buy again, but on your second entry, use your normal size. So this is an example. So traders might have bought here, gotten stopped out here, and then buy again, but this time full size. So they buy a half size position here, stopped out, then they buy the full size position here, so that when the market goes up far enough for a profit, the win will more than offset the earlier loss. Another alternative is to use a very wide stop. And if you do, and you trade small enough, and you get a second signal further down, you can add on to your original position. You always want to keep the total dollars at risk the same. So you trade small enough so that you're not risking more dollars than you usually do. Sometimes traders, when they do this, they'll buy more on the second signal. So let's say they bought 100 spider contracts and the market fell, 30 cents, and they got a second signal. Maybe they'll buy 200 or 300 on the second signal. Here's that example again. So traders, maybe they bought one E-mini here. This is a 5-minute E-mini chart. And then maybe when they got stopped out, maybe they bought 2 or 3 here. After the market goes your way, you can use a tighter stop, and you're in a position to calculate your actual risk, which is usually less than your initial risk. The actual risk is, after the market goes your way, you look back and you figure out how many ticks would you have had to risk to not have been stopped out. And if you have a smaller actual risk, you can go for a smaller profit target, and you have a higher probability of achieving that target than you do of having a target based upon your initial risk, because you're not looking for as far away. Okay, so let's say you bought here above the signal bar, and you used a wide stop, let's say way down here. Okay, and you originally were looking for a move up equal to the size of your initial risk, right? So that might be up here. However, once the trade started to go your way, right, your stop is down here, you bought here, so you did not get stopped out below here because you were relying on this wide stop. So once the market starts to go up here, at this point, you can look back and say, how many ticks would I have had to have for my stop so that I would not have been stopped out? Well, your stop would have had to be 1 tick below this bar. So you bought here, and at this point, the actual number of ticks that you risked was from your entry price here down to 1 tick below this bar. So you could base your profit target on your actual risk, entry price to 1 tick below the low of the move, instead of on your initial risk. And so you can try to exit at a measured move up based upon the actual risk to your entry price, which was up here. Whenever you have a weak setup and you're not quite sure if it's strong enough, it's usually better to wait. When you're in doubt and you think it might be okay, then only buy if you have a very strong bull signal bar, and only sell below a very strong bear signal bar. Here's the situation. Context not all that great. Signal bar is weak, only a 1 tick bull body or a very small bull body. Better to wait and not take the trade. Here we have a bigger bull body, and the context is good. This is a higher low major trend reversal. So that is a more reliable signal bar. So you could buy above its high or above the high of this small signal bar here. Again, signal bar is not great, but the context became much better. Or you could wait until the market became clearly always in long, and it's starting to close above prior bars. And at that point, you can start buying on closes. This is the end of the module on setups and signal bars. Thank you.